Coming to you live from downtown Detroit, this is Benzinga's PreMarket Prep with your host, Joel Elconin.
This is a volatile puppy here, isn't it?
And Dennis Thick.
I'm bidding a penny. I will buy the stock for a penny.
With everything you need to start your trading day.
Good morning, everybody. Welcome to this Wednesday edition of Benzinga's PreMarket Prep. Spencer Israel joined by Dennis Dick. Joel out traveling for the rest of the week with one of his daughters as he helps her move. So just Dennis and I with you here today, but we have a jam-packed show, 2 guests on the docket, and a lot of overnight news. So we had the Trump speech last night, during which the S&P futures hit an overnight high. And a new high for the year. We have Tim Cook defending Apple. We have earnings from Constellation Brands and Lennar. We have earnings after the close today from KB Homes and Bed Bath & Beyond. Virtu came out with their preliminary report ahead of their actual earnings next month. Skyworks Solutions cut their guidance. Clovis is open to a sale, and a lot of ratings, upgrades, and downgrades. Our 2 guests for the day, Michele Schneider, she'll join us at 8:15. She's the Director of Trading, Education, and Research for MarketGauge. And Greg Hartmann, the founder of Dragonfly Capital Management, will join us at 8:35. Dennis, I hope you're doing a little better today than you were yesterday.
It was a tough morning. You know what's funny? These things, sometimes, you start really rough, and then you just find your groove, and then you make out okay. And I was actually playing the open, and I got out of a lot of stocks at a pretty good price on some of the open. And then I decided, you know what? I think we're looking, I even tweeted it out, I think this is looking like a toppy open. And I got some shorts on. And yesterday morning, they came right in. I mean, the Q's opened at like 160, and 2 hours later, we're trading the 157 handle. So I actually ended up having my best day of the short 2019 year. So it started like it was going to be one of my worst days, and it ended up funny, how it turns around as being one of my best days. But it was just a good call on my part. A little bit, a little bit worked out. Some of my opening trades worked out pretty good. And then obviously, making a call to short the market there when we looked a little bit weak, and we had a really weak morning. So that's what kind of saved me, was the open there and the weak open.
I'm happy for you because you seem
the weakness after the open.
You seem like you were stressed out, struggling yesterday.
Well, I was stressed out because I had some bad, and what I had was, and it's my own doing anyways, and you always got to check under the hood there. And I had an ETF, which was EWY, which was chocked full of Samsung. So I was like nervous. I knew Samsung had taken a big hit, and I'm like, I'm gonna get slaughtered in this. Anyways, it's just stupidity on my part that I forgot that EWY contained 20% Samsung, and Samsung, I knew it already had a bad day, so I was kind of mad at myself. But there was other trades too. I had a couple other ones. I was short Novartis, NVS, which had a huge day. Reason I was short that is because it was on Jim Cramer, and it was getting talked up on Jim Cramer. And then it obviously had some independent drug news as well, so kind of just bad luck, and it was going up on me too. So I had 2 stocks that were really destroying me, and then I was like, and then you just get it, it starts spinning, and you're like, and you're in a bad mood, and it's just kind of going like that. So, I mean, even after 20 years, trading can put you in a good mood and put you in a bad mood. I mean, I don't know who can trade. There is some traders that can trade completely unemotional. And obviously, those are your high frequency traders, because those are the machines. So the majority of market makers are all unemotional because they're machines. But I mean, there's some human traders that can trade unemotional too, and that's a skill set that I never learned in 20 years. Maybe it's because I'm an emotional guy. But in any regard here, it ended up working out yesterday. Okay.
All right, so where would you like to go this morning? We have a lot of news to discuss here.
Just a ton here. I mean, you can look and obviously, the big news here this morning was the Trump speech. You're seeing strength in the steel stocks, not surprisingly. Probably Wall mentioned. How many times do we have a word count on how many times the Wall was mentioned?
I wish I did, though.
Yeah, that would be an interesting stat. Anyways, even, you see the U.S. Steel catches downgrade here today from Citi. It's trading up anyways. So, that's probably all backing, from obviously the Trump speech last night. I would think maybe there's some other news there as well, but I'm seeing all the steel strong. AK Steel trading up 3% in the pre-market. So you're seeing metal's going to be stronger here probably today. But, we did have a couple earnings, kind of kicked it off there. This morning, we had ST Zebra, which is Constellation Brands, which is getting the beats, and we had Lennar. I kind of want to start with Constellation Brands because this is a huge fall for the stock. And this is a stock that has been already in a huge downtrend, and now you're going right back to the December lows here. We got down to 156 and a quarter. This is a big fall for usually what is more of a conservative stock. I guess they're getting a weed, maybe getting more aggressive, but I mean, you don't usually see Constellation Brands as a stock that's usually a little more conservative, down 10%.
Biggest number I'm seeing from this STZ report is their fiscal year 19 EPS guidance is light. 920 to 930 is the range they gave. $9.43 is the estimate, or was the estimate. So coming in light on the fiscal year EPS guidance. I don't think the Q3 guidance was comparable to estimates at all, but that's
still making $10, almost $10.
Yeah.
I mean, so it's trading, you can do the quick math on that, $155, trading 15 times. It's more conservative than the overall market, and it's always carried a market multiple usually just as good because cash flows are usually more stable. So it's at a certain point in time starts to get cheap. But then when you go out to the monthlies, and this is what keeps stopping me from getting fully invested here or getting, more excited about this rally. Because when I go to the monthlies and I look at this run from 2012, the stock was $19 in 2012. And yeah, maybe they shouldn't have been down there at those low prices. Obviously, the financial crisis took its toll. It took a few years to get those losses back on a lot of stocks. But you're talking about a stock went from $20 to over $200. It's went up tenfold in 5-6 years. So when you see this fall down to $153, you say, well, yeah, it's significant fall from where it was when it was 230, but should it have ever been at 230? Maybe it's just kind of pricing to where it should be all of a sudden. I mean, weed isn't going to change their whole life. And I know you have CGC here, which with an upgrade here this morning and having a pretty good day. But as Constellation Brands, it's not going to change everything that they're getting involved with weed. And it's not going to, be, a huge cash flow thing for them for a long time. So I don't know. I'm torn. Obviously, the numbers are not good. The stock's trading at 153 here now. It continues to fall. I would say if I am looking, if you were looking at this, you had a double bottom back in 2017 at 144. That was a double weekly bottom. That's the end of 2016 and early 2017. That's $8 away from here. And then before that, maybe have the psychological 150 level. So maybe get a bounce here eventually. But there's so many stocks that have been performing strongly. Why do you want to buy stocks, on weak earnings? Maybe this is the dip opportunity. Maybe it's a time to get in. But I think I'm sitting on the sidelines on this.
I'm trying to look up right now. When does CGC report earnings? So it's scheduled for the end of February. So I want to hold off on any STZ takes until we really see the CGC report, because that was the driver last year, and I'd like to see.
Well, it was to a certain extent it was the driver, but I wouldn't say it was the whole, the overall driver. It helped the whole pot sector.
Yeah.
How much did it really help Constellation Brands? It really didn't help it at all, because if you remember when they put that initial money into CGC, the stock fell like 20 points that day.
Right.
So I would say, it didn't really help them at all, because they were overpaying, in my opinion, and I think that the market thought they were overpaying as well, and that's why they hit it. It was great for the pot stocks. That's what kickstarted the CGC rally from $28 to over $50 in the next month. That was in the summer. So it really kickstarted the pot sector and the pot stocks. But I don't think it was, really applauded by Constellation Brands shareholders. And in any regard here, I mean, spirits maker here, it usually is more conservative. But we've seen, stocks that are more conservative, not comparing it, but, look at a Kraft Heinz. The stock is supposed to be defensive. It's supposed to, perform well in a weaker environment, and it hasn't. And I mean, KHC, and I'm so glad I got out of this. I tried to play this once, and it wasn't working, so I got out. And the stocks went from $90 down to $45 in the last year and a half. It's been slaughtered. You look at all the food stocks. Yes, they've come back here in the last couple of weeks, as everything has. But I mean, GIS, they're all still in the gutter. And Constellation Brands, you can say Budweiser. You can look over there. They're all kind of look the same. They're all still in heavy downtrends here. And you get disappointing numbers in your stock in a heavy downtrend, people will sell. And that's what you're seeing here this morning. 150 will be interesting. That's what DC is saying in the chat. So I say the same thing. Let's see what it does at 150. It looks like that's where it wants to go. Can it bounce there is the question.
Which was the beer stock that was dramatically outperforming? It wasn't Brew, and was it Sam? There was one of them that was, there's not Brew, Sam. There's a third one that I'm forgetting right now. That was outperforming dramatically last year, but can't think of it now. Regardless, let's move on.
I mean, some of the smaller beer makers or the larger beer makers like Bud's, look at the craft breweries are eating their lunch too. Don't think they're not. I mean, you see how many craft breweries are popping up all over the place here. People like the craft breweries. It's different. I kind of like it too. You go, you do a little beer too, you try some beers. You're like, oh, this one's not that bad. It's kind of fun, as opposed to just drinking your Miller Lite or your Bud Light.
It was
And
tapped.
some people are always going to drink the Miller Lights and Bud Lights, and I'm kind of one of them too. But I kind of like having some fun beers as well. So you've got some secular changes here, and some it's attacking the overall beer market as well. Now, Constellation Brands is more spirits, but so we're, you're not talking, it's not really a huge beer maker there. But I think if you're looking at Samuel or Boston Beer Company or Budweiser, they've been in the gutter for other reasons as well, not just market effects.
Thank you very much, Spice.
Tap too, obviously.
Yeah, it was Coors that had
it's held up well, but not really. Like last year, let's look at where Tap was a year and a half ago. Tap was almost $100. It's 61.
You're right. Okay, you're right.
So really, yeah, in 2018, it held up better than some of the others. But really, when you put it in perspective, in 2016, this was a $112 stock. And now you're looking at a stock at 61. It's almost been cut in half. I think the craft brewery has a lot to do with that.
All right, let's look at another big loser of the morning here. That is Skyworks. After the bell yesterday, they cut their guidance. I'll read you that number here. The Q1 sales guidance was cut from $1 billion on the low end of the range to $970 million, well below estimates there. And the EPS was cut by 10 cents from $1.91 to $1.81.
You would normally think it would be a big loser, but it's not. It's a big winner here this morning.
I hadn't even looked at the
stock
chart.
is up 4% in the pre-market on a guidance cut. And that just shows you the expectations were already so low on some of these. We've had Apple cut guidance. This got hit before when it cut guidance. I think, didn't the Skyworks cut guidance a while ago? Didn't they cut
Probably.
like I'm thinking like a month and a half ago or 2 months? I seem to remember that.
Let's see.
Like back early November, didn't they cut?
Let me look real fast.
I can see a big fall in the chart.
They didn't cut their guidance.
I feel like they cut. Anyways, I'm just going for my memory here. I have nothing in front of me, but I feel like they already cut once. Anyway, the expectations are just too low on some of these companies. It's getting to a point where they're just cheap. So you see a guidance cut and you think the shorts are they're kicking their up and they're saying, yeah, it's going to be a good day. Stock initially gets hit. And you know what's it do? It turns around and rallies the hell out of it. So, it's very interesting, how sometimes they just shrug off stuff like this. And you can see how quickly they did. I mean, it got initially hit. You can see the bar down to $63, the little light bar if you're looking at the pre-market charts there. And then, turns around on a dime. So our news algo is probably getting annihilated on that because they see a guidance cut, they automatically hit sell. And, the savvy investor, the human, is saying, hey, a lot of it's already priced in. I'll buy this on the cheap, or, I'll buy this up, and obviously it bounces right back. So, now you think, okay, well, maybe you're getting to a point where some of these stocks are just getting, a lot of the bad news already priced in. When they start going up on bad news, it's usually a sign that, maybe a bottom or at least a short-term bottom might be in. And Skyworks, that might be the case. I think the 60 is definitely safe for now. And I think it might be safe going forward. He was talking about a stock that has been, really beat up as well. Early 2018 was $115. Now it's 66. If you go out even further than that, it was even higher than that, $117. So stock's almost been cut in half. It is an Apple supplier. Yes, it's going to be moving with Apple. Yes, it got hit on the Apple guidance cut there last week. But, I mean, this is a good response to not great news.
So then if you look at peers like Cirrus,
they're up.
Or
they're
Light,
up this morning.
Or they're all up.
Well, this morning, nothing's really trading here yet, but I would imagine they're going to be up. Last night, a few of them were bid up. OLED was trading up here. Cirrus Logic, I believe, had a bid last. No, Cirrus never really traded much last night. So I'm not sure. Cirrus Logic, I'm just looking to see. Yeah, not that much happening there. But you're seeing some strength there. Even Apple itself was showing some strength and is showing some relative strength this morning. Now that might be to do with the Tim Cook interview on Mad Money. They had a lengthy interview there, over 10 or 15 minutes. I wasn't overly impressed with it, but this might be a good segue where we can maybe discuss some of this. Spencer, did you watch the Tim Cook interview?
I watched a little bit of it. Biggest takeaway, biggest highlight, or what people are repeating was his comment that people don't really people underestimate their ecosystem, and they don't really understand it as well. But let's discuss this with our first guest, Michele Schneider. She's going to join us here in a minute. She is the Director of Trading Education and Research at MarketGauge. So I'm going to go grab Mish, and we'll be right back in a moment. And as promised, we are now joined by Michele Schneider, Director of Trading Education and Research for MarketGauge. Michele, how's it going this morning?
Good. Good morning, guys.
How-
We have a very interesting day on tap, I believe.
We do. I hope the new year treated you well. Surprising, I guess you could say a surprising start to 2019. What has been your initial reaction to the first few weeks here?
Well, after the December crash on December 26th, we had that giant capitulation day, and that was sort of a classic type of bottoming formation. So I'm not surprised to see the follow through. Generally, you will get, even in a bear market, a 10 to 15% rally off of some type of low like we saw with huge volume on that December 26th. So that's what we're experiencing right now. From a technical standpoint, we're still seeing buying coming in based on that. And based on some kind of belief, I guess, that some of the worst is over, because last week we had Fed Powell say that he was going to maybe take a more dovish stance with interest rates. The China tariff trade deal, although nothing substantive at this point, there's saying that there's possibly going to be a deal. So right now, everybody's happy. The question is going to be is how long does that sustain? Because some of the problems of the market have not really gone away.
Such as?
Well, for example, even though Powell had a dovish stance, he knows very well that he cannot get too dovish, because if he lowers the rates or even stays pretty much where he's at right now, there is a risk of igniting inflation. And this is something that we've been looking for quite some time. We had the initial rally in the gold, and that has now come off a little bit from this last swing high a couple of days ago. But nonetheless, some of the soft commodities that have been lingering at their lows are starting to show some signs of perking up. So if he lowers rates much more, he does run that risk of really igniting inflation to a greater degree, number one. Number two is that we do have a situation where a lot of foreign countries have really reduced, if not completely halted, buying our debt. And today the story came out that Fitch might down the road reduce the United States credit rating from AAA. I remember 2011 when the S&P reduced the credit rating of the United States after our government had been closed for a very short time compared to the longer time we're doing now, and it was disastrous for the market. So we have that. Then on top of that, we also have the dollar. The dollar is sort of like right now a loose cannon, because if the dollar continues to decline, and by the way, there's also talk of the fact that a lot of foreign countries are considering potentially going away from the dollar as the world currency, that could be another real nail in the coffin. So I'm watching the dollar. At the very least, at this point, it seems to me that we could see somewhat of a slowdown, if not necessarily a recession coming our way. And we have earnings coming out, although we haven't really gotten into the meat of it yet with all the big stuff. I saw Constellation Brands, for example, reported this morning, and now that's down about good 12%. So a lot of corporations are saying that this quarter earnings, they're going to either revise downward their growth. So there's problem after problem after problem, not the least of which is also just politically the problem with the government close and what's going to happen with the standstill between the Democrats and the Republicans and the wall, et cetera. So I think we are somewhat at the close of the end of whatever this rally is, but we can look at it technically.
Okay, so then from a trading, I guess we can talk both from a trading and from an investing standpoint, but from a trading standpoint, how are you approaching this market given all those risks that you just stated?
Well, I'm looking at certain trends that could, I mean, listen, if the market we've had three major downturns in 2018, two 10% moves, and then the more recent move down about 20%. So that tells you something. There is definitely some issues in the market. So the way I've been approaching it is from my sense, of course, I'm an active trader. I can take on positions and catch that wave up, keep tightening my stops, and take some profits along the way so that I would not get hurt if the market turns down. What concerns me are the more passive investors, friends of mine who have been saying to me, the market always comes back, right? And, you know, historically in the United States, that's been relatively true, but not true in the world. You look at a stock market like Japan, 30 years later, they're still nowhere near where they were. So we could get some kind of a sustained move down if something happens along all those parameters that I just spelled out. So as a trader right now, I'd say ride the wave. But if you're looking at the Russell, let's say, which, you know, is my favorite index to look at, if that breaks down under 140, I would probably say, and right now it's trading 142 pre-market, I would say that's probably a good sign that this rally at least is ended, and how much it goes down would remain to be seen with all the other factors that we've just talked about.
Hey, Mish, Dennis Dick here. I just want to expand on something you were just saying, you know, bringing up Japan in 30 years. And I think a lot of people don't realize, you know, that their markets are still down 30 years later. And long-term investing has always worked in the U.S. I'm going to put my long-term, like, I'm a trader, but I'm also a long-term investor here too. And I've raised some cash just because I'm concerned as well on some of what's happening here in the long-term picture. But something I've always thought about, and I just want to get your thoughts. You know,
wait, I'm sorry. I'm sorry, my dogs are
the dogs are barking. Dennis,
the dogs are
God.
barking.
Hit the sell button. Hit the sell button. Oh, no.
Probably because my husband's walking around the house and they heard him.
The dogs are barking, so they're maybe not liking what I'm going to say. But I've always been concerned that, you know, if you kind of just take the big, you know, the big picture and look, and I just wanted to see if you have any similar thoughts. If you look at where the growth came from, you know, back in the 60s and 70s and 80s, and even the 50s and 60s and 70s in the market, it came from population growth. I mean, population was growing, the world was growing, but at a certain point in time, population doesn't grow anymore. So, you know, you could say in the last, you know, 10 or 15 years, the population is definitely not growing as fast as it was. And the way the economies have gone around that is now, you know, it's built on debt. So if you don't have more people consuming more products, you give them more money to consume. So, you know, now everybody's, you know, built on debt. You know, back in the 70s, they had 30, 40% for a house. to have down. Now we have people in houses that don't have anything down. So obviously debt is a lot more here as well. So where does the growth come from in the next 30 or 40 years if the population isn't growing and we're already, in so much debt, 20 trillion in the US? Where does the growth really come from for the next 30 years to drive us from, say, Dow 20,000 to Dow 25,000 to Dow 100,000? Where does that growth come from?
I couldn't agree with you more. I mean, even though we have a lot of growth still to go in the technology part of the sectors, obviously AI is not going away, and there are going to be advances that we're going to see, let's say, in the 3D space, which we're already seeing, as far as helping humanitarians, not just from a medical standpoint, but even being able to build houses from a 3D standpoint, which would help for deforestation with lumber. There's going to be advances in terms of what happens for humanity, but in terms of what you're saying, in terms of humanity itself, where's the growth coming from? That's a really good question. I mean, right now, even the middle class has declined so much. So that's a huge concern. The divide between the haves and the have-nots continues to increase. They're saying 0.1% of the wealth owns 84% of the stocks in the stock market. That's pretty mind-boggling. But on the other hand, there is more than ever a closer tie to American wealth and the stock market than before. So you're right. I think that we do have some real legitimate concerns. The millennial generation coming up, although that population is growing compared to, say, the baby boomer generation, they have a very different philosophy about what they consider to be growth. And I'm not sure what they're thinking about in terms of procreating and having children. I mean, I don't know if the age of the big family is going to continue to decline with this next generation coming up. So I think, Dennis, you've got asked great questions, and it is concerning to me. And I do believe that if we see a lot more damage happen to what we've already sustained with the dollar and with the debt, et cetera, that we could be in for a very long period of having difficulty seeing any major type of growth like we've enjoyed for the last 50 years.
You did say growth. Can you give us a couple stock picks, Mish? What sectors, like you like technology? Is there any stocks specifically that you think, long term that are going to be okay even if we don't get the growth?
Yeah, there's a few things. I mean, I think if you look at just the trends, the social trends that are happening. So number one, I do believe that marijuana space is something to keep in mind. And I know you guys at Benzinga are big into doing marijuana type of stock following, and you've done your conferences, et cetera, in that space. I believe that would be an area that would see continued growth, because on the medical standpoint, on the recreational standpoint, I think right now, we have 33 states that have some form of legalization, and that looks like that's only going to grow, even with the problems with the FDA. The Farm Bill passed the CBD and the hemp. That's a positive. So that would be an area where I would look. I would also look at alternative energy. I mean, right now, our country emissions has gone up in terms of gas emissions, but yet the rest of the world is still relatively concerned, and particularly China is very concerned. So I think if you looked into solar and alternative energy stocks, that could be an area of growth. I also believe that if you look into, I mentioned 3D space, I think the 3D printing space is going to be a technology that will eventually become more cost effective. So that also could be an area. Now, in terms of specific stocks, what I've just talked about, there's a few. I think you have to watch, the big pot stocks like GWPH and Canopy Growth, and even some of the smaller ones in that space, like New Age Beverage is an up and coming company. They're in the beverage space, and with the Farm Bill, able to look at using CBDs for more medical purposes in their beverages. I think if you're looking at the 3D space, the mother of the 3D space is 3D printing, the symbol's DDD. That is now floundering about over 10. Obviously, if the market crashes, everything's going to be affected. But if the market bottoms, this is where I would go. And this is where I did go last week. And so in the solar space, the granddaddy of solar is still First Solar. Of course, Canadian Solar has just made a big move. So that's where I'm looking at. In terms of the tech, I think, the semiconductor space has gotten hit really, really hard. So I'm not sure yet what will emerge as a leader right there. I'm still doing research on that because I am concerned that with tech being so overvalued, it could see a big decline even further than we've already had, especially if the market starts to turn down, before I would say, okay, this is the AI stock I'm looking at, or the chip stock I'm looking at, etc.
All right, Michele Schneider who has been on with us right now. She is the director of trading, education and research at MarketGauge. Michele, thanks so much for the time, and we'll talk to you again soon.
Great. You guys have a great day.
All right.
And by the way, FOMC today. So there's another factor to be watching. So this is definitely a market that requires attention.
All right. Keep that in mind. Thanks a lot, Michele.
All right. Thank you so much, guys. Have a great day.
You too.
Thanks, Michele.
All right.
Bye-bye.
S&P's just sort of hanging out here, Dennis. I got distracted. I forgot to bring up Apple with her, but we were mentioning before she came on. Actually, before I even get to the Apple, real quickly, her commentary about cannabis provided a nice segue for me to mention, if you are in the Miami area next week and you want to go to a really cool conference about cannabis, the Benzinga Cannabis Capital Conference is next Tuesday and Wednesday, Tuesday night and all day Wednesday in Miami Beach. I'll be there. If you want to hang out with me, you can do that. So
you're going to Miami?
I'm going to Miami. Yes.
You got the lifestyle.
I didn't tell you.
I tell you, you got the lifestyle.
Yeah, I'm going to Miami.
I want to go to Miami.
Okay.
Problem I got to trade and I have
you
two
can
kids
come
here,
to Miami.
I don't go anywhere.
All right. So anyway, that's next Tuesday, Wednesday. Cannabis or Benzinga CannabisConference.com.
So jealous.
For that. But back to the Apple before we get to our next guest here, Dennis. So Tim Cook, defending the company yesterday on CNBC, said he doesn't think people really understand or appreciate their ecosystem, thinks it's all about, how many iPhones they sell over the previous quarter. It's not about that. And overall, I think, a pretty good defense of the company as he's supposed to do. He's the CEO.
Nothing wild, though. Nothing unexpected in that interview. I was tweeting with Nick Shaheen as well, just as we were watching the interview there. I don't know. I mean, he did a fine job. I don't think he blew me away or anything. The stock did go up on the interview. It was trading like around 50.75 in the market. It was actually down at that time. So it did rally about 50 cents. It was trading up to 151, 20.25 last night. So it did rally a bit on his interview, but that's typical. It is up here this morning again. That's market effects here. He didn't blow me away, though. It wasn't like he said they're going to be launching some new stuff. But, it wasn't like nothing blew me away in that interview. I'll just say that. So obviously we know, this is still a cash cow. It's an iPhone company. They need to diversify themselves away from that. He was, saying that the growth in non-iPhone products, I think he was saying was 18%. So he's saying they are getting that growth, but we still know this is an iPhone company that needs to find other revenue sources, because the iPhone revenue, yes, it's a gravy train. Yes, it's going to continue, but it's not going to grow like it was. Everybody's got one. Everybody's got a cell phone. So the growth isn't going to happen from that. It's, I'm still sitting on, I think I'm sitting on, I don't even know what it is. It's not even the 7. It was like the 6S or whatever, so it's a different model of the 6, and it's working fine. So I'm not going to upgrade my phone until they have something really awesome on the new phones, or until I have to. We know after like 3 or 4 years, 5 years, these things seem to, lag, or they seem to die.
They do.
But just, when you look at it, they've got to diversify themselves away from just iPhone.
Well, look, people were pointing to the headline from over the weekend that the Samsung TVs are going to the new ones are going to include some Apple services. Like the smart TVs will include some Apple services within them. That's a great endorsement for Apple as a services company, and it speaks to what they're trying to do. So it's not like they're not making progress in that area. It's not going to be as big as the iPhone was. It was the greatest product in history. So
it was. And obviously, you can even think to where that came from. It started with their iPod, and I can remember my buddy Chris Bannon, when he bought it, the first iPod. The original iPods were just like, a little, like it was small, but the second one had that screen, and where you could flip through and look at the album covers and look at, that. I was like, that is one of the coolest things I've ever seen. And that eventually became the iPhone. So, that's where you make the money, is when you find a product, it's like, really wows you, and it's early in the cycle, and it's like obviously doesn't have a valuation of 1,000 times earnings, or or 10 trading 50 times cash or something like that, that's where the money's made. It's hard now in the information age, though, where we are. This was obviously back in 2006. The information age now, like 12 years later, stuff gets out there so fast and people get so excited so quickly, they tend to overpay for some of these products, this newer stuff. There's cool stuff that comes out all the time. But you can look at how cool is Square, being able to process payments from anywhere, really. The technology is fantastic. But when you're paying 70, 80, 100 times, or that's just what happens, and the stock gets cut in half from 100 to 50 when those betas come down. So it's like growth at a reasonable valuation. That's what you've got to look for if you're a long-term investor, and look for those potential. And and sometimes you can pay up, and sometimes it's good to pay up, and other times it's like you get punished for paying up. So just because it's got a cool product doesn't mean it's necessarily a good stock.
So real quick before I grab our next guest, Apple here closed at 150 yesterday. Where do you stand in the short term?
I'm still long it, so I'm sticking with it just because the cash cow. It's in my long-term retirement account. I'm in from $90. That's where I originally bought. I sold some on the way up, and I obviously sold way soon. I think I sold at 150 on the way up. That was last year,
okay.
And obviously I was way soon on that. But I'm still sticking with the rest that I have, and I'm playing with a lot of the house's money now because I had sold over half my position there at 150 on the way up. So I'm fairly comfortable with my Apple position. It's not an oversized position. The only oversized position that I have is the stock we can talk about right now, and that's Virtu Financial.
Let's talk about
I've talked about this.
I've talked about this
on the show for the last 2 months and saying they're going to kill it. They got to be killing it. And anybody who's listening to the show, I've been talking about VIRT. I've obviously, I kind of put my money where my mouth is. I believe it's the biggest position besides ETFs, like straight out stocks. Right. I think it's the biggest position in my investment portfolio.
So let's talk about Virtu with our next guest. Greg Hartmann is going to join us in a moment. Here is the founder of Dragonfly Capital Management. We'll be right back with Greg. And as promised, here we are now. Greg Hartmann, Dragonfly Capital Management. Greg, how is it going this morning?
No, it's going okay. A little snow overnight, so the weather has changed quite a bit, but the market still looks like it wants to go a little higher.
All right, question on everyone's mind then, Greg. This market that looks like it wants to go higher, is the bottom in, or is this just a short-term bounce?
That's the big question, right? For me, it's not answerable at this point in time. We've had a lot of V-shaped bounces in the past, but at this point, you're looking at the S&P 500, and I look at the ETF, the SPY. It fell out of a consolidation range that had 260, 250 as a low, or 263 as a low, and we're still well below that. So it could still jump up to 263 from the 257-ish it is right now pre-market, as just a retest of the breakdown before reversing. So it's got a long way to go before I'm willing to put any long-term commitments into play.
So what has to happen for you to get to that point?
Well, we'd have to see the SPY get over 263 and continue to move higher. Ideally, a move back over 280 would be the best, but that's giving up a lot of space between here and then. So we're taking advantage of options to limit the downside potential, essentially making a trade based on committed and defined capital risk to take advantage of the bounce.
Can you break down that trade for us? In what way are you using options?
Well, if you look at the SPY, shortly after Christmas, we went and bought the September 255 calls in the SPY. Those cost at the time about $15. They've improved obviously with the market going up, but what that means is that instead of risking a big gap down day, say that the SPY moves from 256 to down to 235 in a day, and you lose $20 per share. These options that we bought for $15, the most you can ever lose on them is what you paid. So $15 is our total risk in them. My plan, how I execute these types of trades, is to go and buy these, and then if I'm right and it moves in the right direction, I look to roll them up, which means take the 255s that I have now. They actually started as September 250 calls. So as the market started moving up, I sold the 250 calls and bought the 255 calls to maintain some upside potential, but to get some of my capital back. So I had less net at risk.
All right, let's talk about some other areas of the market here. We have a lot of news this morning. We were talking about Apple earlier. We've been talking about Constellation Brands. Virtu had a guidance raise. We had some earnings from Lennar. I mentioned STZ already. We have a lot of commentary from some analysts here this morning. What's on your radar today?
Well, actually, Constellation Brands is one thing that I've got to deal with today. I sold some strangles into the earnings event, and was definitely not anticipating the move that we saw here. This is a nasty leg down for liquor.
So let's talk about that. So let's talk about that then. So you have a trade that went against you. Walk us through how you're going to work out of it.
So yesterday I sold a strangle that expires on Friday. I sold the 157.5 puts and the 187.5 calls. Obviously the calls are going to expire worthless, so that's good. I get to keep all the premium that I sold there, but the puts are going to be a problem because now they're at 151 here. They're about $6.50 in the money, so it's a $6.50 loss. And I didn't get $6.50 for selling the strangle. I only got $1.70, so about 1% of the value of the stock. So how do I get out of that? Well, there's a couple ways to do it. You can just eat the loss, or you can take some time to get out of it. And similar to the rolling strategy that I talked to for the SPY, it's a similar strategy to get out of the strangle. So the 157.5 puts that expire on Friday, I can buy them back and then sell out puts that expire at a longer maturity and hopefully at a lower strike price for an equal amount of money, or even for a credit, to be able to give myself more time, give the stock time to possibly revert and move a little bit back higher. So it's a time play.
Do you frequently play stocks right before their earnings? Is that part of your strategy?
I'm sorry, I didn't hear the whole thing.
Do you play stocks like this right before earnings, like you did with STZ? Is there something you saw on the chart, or was it all about the earnings, or what?
Yeah, it's I do. It's part of my service, the subscription service. I do offer earnings trade ideas to subscribers. Generally, the day before the companies are reporting. So, like tonight, we've got Bed Bath & Beyond and KB Homes reporting. So I'll probably offer trade ideas on Bed Bath & Beyond. And oftentimes I do take the trades. Constellation Brands looked like it was prepared to move $10 or so. Options priced in about a $10 move, $10.50 move. And clearly, the options market makers did not have that one right.
It's Greg, Dennis Dick here. I just thought to expand on this because it's an interesting strategy, and we see a lot of people who like to write options. I mean, you're basically selling insurance to the market in both directions when you're doing a strategy like that. How often, and we know, just think of the insurance industry. I mean, you make little money. You make a lot of times, and obviously sometimes in the insurance industry, and then you have to pay out a big one. I mean, isn't this just kind of like, okay, this is one I've got to pay out?
It is kind of like that, and maybe like the insurance industry, but maybe a little bit differently. There's lots of different ways you can trade this type of one. With Constellation Brands closing yesterday at 171 or 172, right in that range, you could have sold a strangle or sold a straddle, like selling the 172 call and the 172 put at the same time. Strangles take a little bit of the risk off the table because obviously the stock has to move a significant amount before there's any risk you take on. So in this one, it was 172 down to 157 before I had any risk. So that was almost a 10% move. That would have to be before there was risk in the trade for me. But yeah, it is making a bet that the stock will not move so much, that the impact of earnings will not have significant enough impact on the stock price.
So we've got Bed Bath & Beyond and KB Homes here after the bell. Without giving away too much, you want to save the goods for your subscribers, obviously, but without giving away too much, can you talk us through a little bit what you're seeing? Let's say if I pull up a chart of Bed Bath, can you talk us through a little bit of what you're seeing?
Well, Bed Bath & Beyond has been a crap stock for a long time, right?
Oh yeah.
Started dropping at the beginning of 2017, and it's down, something like 70% or so, maybe more since then. Has continually been below its 200-day moving average and hugging around its 20-day moving average. So it's been kind of like a constant move down. Currently in a little bit of a bounce, but still with negative momentum, improving but negative momentum. When I take a look at that, I would say it's a stock that's had lots of problems in a market that's been a little bit weaker, and it's fallen in that market. So is there a bias to the upside? Perhaps. It's got huge short interest, over 24% short interest. So that would play a role in it as well. I'm not going to want to sell any upside calls that would put me at risk of being short the stock, that don't consider the impact of a possible good report and short covering, making for a short squeeze. But when I look at the options market, it's pricing in about a $1.50 move. So about a 12-13% move. It's historically been about 14% move. So the options market is pricing in a similar move to what we've seen in the past. So selling something outside of the large open interest areas might work here. You've got with the stock at 1185 pre-market. You look at the options for this week, and you see this huge slug of open interest in the 10 strike put. Maybe that's a draw, but it also might act as a break in terms of the stock price going below that. So those are some of the things I consider when I'm picking strikes and picking trade opportunities here. So you might sell something below that 10 strike and then buy a call spread on the upside for the potential bounce.
All right, some food for thought there from Greg Hartmann, Dragonfly Capital Management. Greg, as always, thanks for the time, and have a good rest of the week.
You too, guys. Have a great one.
All right, Dennis, before we went and grabbed Greg, you wanted to talk about Virtu, so let's do that. We know it's one that you've been highlighting for couple months now at this point, as one of your larger positions. They were not scheduled to do anything today, but they came out with some preliminary earnings, I believe is what it was, and they announced net trading income, or they expect their net trading income to be in a range of $285 to $298 million versus $237 million last year. So they expect a dramatic increase in trading revenue there. And this is one that is popping here this morning.
I mean, and they did like look at some numbers for last quarter, which we've been talking, that they probably, we're going to be blowing it away. I mean, Virtu Financial is operating. I'm operating a lot smaller scale, obviously there, but a lot of overlap in strategies. And that's why I get a really good feel for a company like this, because we're doing a lot of, different types of arbitrage, statistical arbitrage. They're doing a lot more market making. I don't do as much market making anymore because it's difficult to compete with Virtu and Citadel when they've got order flow in different, ways. So, but I understand the business very well, and I had one of my best quarters in years. So I was like, well, Virtu's got to be blowing it away too. So I wanted to buy. I've actually got, this is one of the largest positions in my long-term portfolio, but I also wanted to buy it in my swing trading account before they reported. Well, they pulled the wool over my eyes because they reported early. So I didn't get to put it on for a swing trade, but I obviously still, it's one of the largest positions of my long-term account. So I'm pretty happy that stock's trading up 2 points here this morning. I don't know if it's going to have a lot more legs than this. I mean, some of it's got to be expected. I think I'm not the only person in the world that thought Virtu was going to have a pretty good quarter. So it's trading up 8%. If I had it on for a swing trade, I'd probably be ringing the register. I'll probably stick with it though. I mean, I've been in this a long time. 30 is going to be absolutely huge for this to try to get through. I can see the book is littered up there, even in the pre-market book. It's going to be struggle to probably get through 30. It's a big psychological level for it. When I was buying this in the 19 handle, and that's a long time ago, I was playing it as a play on volatility. I was playing it as a defensive play, because when volatility increases, Virtu Financial is going to do better, and obviously that's worked out. I'm up about 50% in the trade now, and this is in the long-term portfolio. I'm probably sticking with it, although the 30 makes me want to lighten up a little bit.
And so you're not, I mean, you obviously own a lot of it. You're not looking to buy more up here, though.
No, not chasing it. If anything, I would be lightening up my position because it is a pretty big position. It's gotten bigger. I mean, it was a big position when I originally put it on because I was pretty comfortable with it. And now I'm looking at it that, I'm up 50% here. And really, since October, you can look, this thing, trickled down in October to 1996. So really in the last 2.5 months, it's up 50%. Well, it's been a good quarter, so that's probably warranted. But if you're coming up here now, I think you're buying somebody else's profits. So that's why I'll probably, if anything, I might lighten the position, but I'm definitely going to keep holding on to some of it.
All right, let's look at some ratings here this morning because we do have a lot of them. One that jumped out to me, we are having some analysts disagree on Nike this morning, one upgrading, the other downgrading.
It's always interesting.
HSBC upgrading Nike to buy, and the downgrade was, let me find it here, Baird upgrading them to, or downgrading them to neutral.
So, and last night the original upgrade came out and the stock was trading up, and then this morning you get obviously the downgrade. It's had a nice comeback from the lows. I mean, we were $66 here on the 20th. So now you look at it and it's back up at 76, maybe $77. You got a couple pesky highs up here. If you look at the daily, $79 a high on the third, 78.40. I mean, you come in an area with 77, 78, 79, it's going to be resistance. So if you're coming here now, I think you're late to the party. I think you're 10% late to the party. The buy was when it was under 70, and the more of the selling point I think is up here. So I actually like from the short side up here at 77, 78 better than the buy.
Baird downgrading Nike, but upgrading Foot Locker to outperform.
Stock has come back a long ways too. I think Baird late to the party on this one as well, though Foot Locker is going to trade up, thinner issue, so it's probably going to trade up a buck on this. Yesterday's high, 57.75. See if you can break through 58. Trend is your friend in the short term here. It's had a really nice move, but again, 47 to 57. I mean, you're talking 15% moves in 10 trading sessions. This is the very definition of chasing. And then you got a couple pesky highs back in April, 59 and 59.40, or back in June, 58 and 59. So you're starting to come into a resistance point there again. So again, if you're buying it here, I think you're way late to the party.
Did I miss some fundamental news on UNP, Union Pacific? Because they've had like a bunch of upgrades this week.
Oh, CEO.
Oh,
they got the new
okay.
who just came in. It was 2 days ago.
Okay.
And it was a big name that came in. So Union
Yeah,
Pacific.
Jim Venna. Jim Venna. Okay. That's what. Yeah.
That was the big news.
All right,
So that's what really drove it up there. And, was it CEO or COO?
It's COO.
Yeah, the COO. So anyways, big name to pick up. That was the driver there 2 days ago. And wow, that's similar. Remember CSX had that big move too?
Yeah.
CSX had a huge move. I remember that because I was short the stock and I was like, how much can this new COO be worth? Or I think it was maybe CEO, and it was worth a lot. And I got the beats on that. So that's why I probably didn't get the beats on this Union Pacific one, because I know there were some traders thinking, well, this can't be worth more than $3 or $4. Ends up being worth over $10. So it's hard sometimes, then they get a big name. Sometimes it can really drive the stock price up, and that's what it did.
UBS with a note this morning on the financials. They're upgrading MasterCard and Bank America. MasterCard upgraded to buy. Bank America upgraded to buy as well.
It's a pop. MasterCard, I'm still long in my long-term portfolio. I did lighten up. This was one that I took part of the gain there. And I bought MasterCard during just after the financial crisis, like 2010, 2011, and I'm averaging at $16.
Oh.
So I'm likely never going to be down in that. But, I was like up over 1,000%. I sold some at 204 back in, I think, November, when I started getting nervous about this overall market. It's come back a long ways here now. I'm still I'm still in MasterCard. I'm still sticking with what I have, but I've sold over half. So I'm playing with completely the house's money, even a lot of the house's money, because obviously I've made almost 1,000% on this trade or on this investment. But it's just went a long ways too. And I'm still nervous about the overall market. And if the overall market turns south, MasterCard will fall hard. So that's why I'm not coming here buying MasterCard either. I mean, here's another story. On December 24th, stock was $171, now $195. It's a big move in 2 weeks. Yes, maybe it was oversold, and we said it was oversold back then, when I was calling for the 1,000 Dow point rally. But, now you're getting to a point where it's not as oversold anymore, and maybe it's overbought in the short term. So you get up near 200, I think you got resistance, and I'm not adding to it up here.
I guess they liked MasterCard getting rid of the words on their logo and making it just the colored circles there. Another one, Morgan Stanley this morning is downgrading Expedia and Booking Holdings both to neutral.
Go check them out. So Expedia down $2.22. That's had a good run up too. I mean, everything looks the same. Everything's just run up. Booking, interesting, does not look the same. Booking had an awful day yesterday. What happened with Booking yesterday?
Ooh. Was
there news on that yesterday? 1755 was a high. It sold 70 points off the highs yesterday. I didn't look at the stock yesterday. So if anybody in the chat can help us out there, I can just go look, and look at the Trustee Benzinga Pro and see what the headline was there too.
I don't know if there was news.
So it had to be something. Anyways, I don't see anything really jumping out at me either. But wow, what a turn yesterday. So now you get the analysts ganging up on it and it's knocking another 41 points off the price here. That's significant too. I mean, it's only 2.5%, but wow, talk about 1755. So you're down 100 points since yesterday. So wow, that's a big move for it. The chart not looking nearly as pretty here. Expedia not looking, it's come up here, but again, trend is not your friend. These stocks are all in downtrends here. You've had rip your face off rallies the last 3, 4, 5 trading sessions in a lot of these stocks, and it's a nice rip to sell if you're looking to get short or if you're looking to take some profits. Maybe you bought it on the cheap. I mean, the trend is still down, and I like selling rips and uptrends. So I kind of am on board with the Expedia downgrade. The Booking, maybe because of yesterday's sell-off, maybe a day late to the party. But again, these stocks are all in downtrends now.
All right, 8:59, Dennis. Any final words? Want to give us some imbalances fast if we have?
Yeah, we'll look here. GE 218,000 to buy. AT&T, we know I've been playing this here. I've sold a lot of it in the pre-market. I tend to, get out of it all here. Buy the open does have 168,000 to buy, so the buy balance is back here again. But it's ex-dividend here today, so obviously your adjusted price is $30.77. $30.77, close to $31.28, paid the dividend, so $30.77 is the adjusted price. Does have a small buy and balance, which I think I might be selling into here at the open. Taiwan Semiconductor, 155,000 to buy. Visa, 101,000 to buy. I'm seeing some buy and balances here this morning. Alibaba has been on a run, man. And this is quietly has run up 20 points here in the last 4 trading sessions. in 2019, $129 at the beginning of the year, and now we're looking at the stock at 150. I'm in Alibaba. I almost feel like, at this point, I'm actually think I'm greening again. I bought it like at 144, and it got up to 170. I wish I would have sold it. Went all the way down to 130. Now it's back. I put it in the long-term portfolio, so I don't like to trade my long-term stuff. But man, this has been a nice rally. And if you think about the 50%, you're right there, just over there right now. I think you're going to run into resistance 151, 152. I think if you're buying it up here, you are very late to the party.
All right. And any final thoughts today, Dennis?
Same thing. We've had an overextended rally here from the lows. I don't know how long it continues for, but I do believe eventually we're going to retest some of these lows. I don't think we're out of the woods. So I'm still, can it continue? Well, it has. It has continued here. So I don't know when it's going to turn. I've said SPY could eventually go to 2,600 or 260 on the SPY. I think that feels like where we want to test to, but it's hard to say if that's going to be the stall-out point, if that's where it's going to turn, if we're going to get there or not. But if you're looking for that last 2 points, and maybe you're sitting on a 10-point game, maybe you want to lighten up and take some of those profits.
All right, that's it for us today. If you missed any part of our show, catch our podcast. We're on iTunes, SoundCloud, Stitcher, TuneIn, and Google Play, or just watch us on youtube.com/Benzinga TV. Thanks to our guests, Greg Hartmann and Michele Schneider. Thanks to all of you in both of our chats on YouTube and premarket.benzinga.com. As always, please remember that all the information from our show is for informational purposes only and not meant to be investing advice. Hope you all have a good day, and we'll see you on Thursday.